As you go through life, you might end up with several retirement accounts, or maybe a lot more than that are scattered all over the place. And so the question becomes, should you consolidate those accounts or get everything under one roof? And what do you need to know as you evaluate that decision? So that's what we'll talk about for the next couple of minutes here. And in this case, consolidating means combining multiple accounts. So you might have an old 401k from one job and another 401k from another, plus some IRAs, and you might combine all of that into a single IRA. In some cases, you can't get everything into one account. For example, you might have Roth money, and that needs to be kept in a Roth IRA, and your pre-tax money stays in a separate pre-tax IRA. But the idea is that you're reducing the total number of accounts or the total number of vendors or custodians that you work with. You'll often hear the suggestion that you should consolidate your retirement accounts from the various financial services companies you work with. So that might be a big company that you have your IRA with, or a financial advisor that you're working with. In general, they're going to suggest getting everything under one roof. So combining those accounts can certainly simplify your life, and that alone might be enough motivation to do it. But there are some pros and cons that are really important to consider. So we'll talk about those, and be sure to stick through to the end, because we're going to debunk at least one major misconception that clients often ask about. They think it's an advantage of combining these accounts, but it's not necessarily that much better. As you might have guessed, it's a lot easier to manage your investments when you combine those accounts. That's because if you only have one account or fewer accounts to manage the investments in, it's easier to keep track of what's happening. It's easier to keep things in balance and otherwise avoid forgetting about what's going on with one of those accounts out there. As a result, you're more likely to be taking the amount of risk you actually wanted. So you've got the right amount in stocks versus bonds versus overseas exposure and any other asset classes that you choose to invest in. There's also a lot less paperwork, and that can mean less clutter. So if you have numerous accounts, you're going to be getting certain disclosures and forms from those accounts every year. That might be statements or trade confirmations, updates on various things, and you need to keep track of all of that stuff. Plus, for your security, you may want to destroy those documents so that you can prevent identity theft, and you may want to recycle the documents to help reduce waste. By having fewer accounts that you have to get emails and mailings on, you're going to reduce the amount of clutter you have to deal with. Managing your RMDs can also be easier when you consolidate your retirement accounts, and that's because you may eventually be required to take distributions, those required minimum distributions or RMDs, and you can potentially do all of that out of a single account if you get everything into a single IRA. Even if you have multiple IRAs, it's possible to combine the RMD, or what's called aggregate the RMDs, and take that out of one account to satisfy the RMD for multiple accounts. But you can't do that for 401k plans, for example. So if you have multiple 401ks out there, you would have to take a separate RMD for each 401k that you have. And that's not necessarily a bad thing. But if you could simplify life and do it all out of one account or fewer accounts, you might appreciate that. You might also get better pricing by combining your accounts. Now, this isn't always the case, and it's not always a significant amount, but there are two potential ways to save money when you combine those accounts. One is that if each account has an annual fee, you can eliminate the multiple annual fees by getting everything into one account. And secondly, if higher asset levels lead to lower costs, you can potentially save money that way. So this could be the case if you qualify for better share classes that are less expensive, or if you meet a tier on the pricing for a financial advisor that helps to bring down your costs. You might even qualify for fee waivers or other benefits, so this is something to think about as well. Next, we have fewer passwords. This might not be a huge deal, especially in the era of password managers, but you do have less to keep track of. You don't have to update those passwords quite as often and keep going through that process. Just one more potential little perk here. But a bigger deal might be that you can make things a lot easier for yourself as well as for your heirs and your executor. So this comes down to managing beneficiaries first. It's easier to keep the beneficiaries up to date if you have fewer accounts. And after you pass away, you're going to make things a lot easier on those who are managing your affairs. Your personal representative or your executor is going to have to chase down each of those accounts you have, and they may need to make phone calls to each of those vendors. They may need to submit documentation. That means getting extra copies and extra mailing time and waiting, then eventually making the distribution. So all of that becomes a lot easier if you have fewer accounts to work with. Ultimately, when it comes to your beneficiaries and your estate management, we don't want anything to fall through the cracks, so you just can improve the chances of everything going smoothly when you simplify. By the way, I'm Justin Pritchard, and I help people plan for retirement and invest for the future. And you're going to find more information about this topic in the description below. And more importantly, you'll find some general retirement planning resources that I think you'll find really helpful. So be sure to check all of that out. And it's also a good time for a friendly reminder that it's just a short video. We can't possibly cover everything here, so be sure to review things with your financial advisor, your tax expert, and attorney. Another potential benefit is that you can leave your employer plans behind. Now, this isn't always an advantage. It can work against you, and we're going to talk more about that in a moment. But in some cases, you're better off removing your assets from a 401k, for example. And that's because your employer controls what happens with the 401k. So which vendors do they use, and which investments are available in the lineup, and what do the fees look like? So if you can do better outside of the employer plan, and sometimes you can reduce your fees or get better investment options, then that may be a reason to consider consolidating. And the last one I have listed here is preparing for aging. This is not something that's fun to think about, but you're not getting any younger. None of us are. This isn't anything to be ashamed of or anything like that, but we all naturally lose some cognitive ability as we age, and we may not make the best decisions. We may have a harder time keeping track of things. There's some research to suggest that, especially with financial type things, that things can get difficult. So if you can simplify your life, it is going to make it easier for you and or your powers of attorney who might help you with these types of things. That said, it could also put everything into one place, which would make it worse if you end up getting tangled up in a scam. So we've covered some benefits, but let's dive into some potential disadvantages of combining those retirement accounts. And one of the biggies is that your money might be better off in the employer plan. I've got just a few examples here, but for example, you may be able to take penalty-free early distributions out of your 401k. That's the case, for example, when you use the so-called rule of 55, you stop working for that employer after age 55. And when you do so, you could pull money out without an early distribution penalty. So normally you can take money out after age 59 and a half with no early distribution penalty, but having it in the employer plan may allow you to go as early as 55. And for some people, it's even earlier than that. So if you have a 457B plan, for example, you may be able to take the money out basically at any age without any early distribution penalty. And public safety workers also may have the ability to get early distributions without a penalty. There's also NUA, or net unrealized appreciation. If you have employer stock in your 401k, that doesn't apply to many people, but it's something to keep in mind if it applies to you. And you might have a really nice 401k plan or 403b plan, or the TSP, for example. You might have a perfectly good plan that you don't necessarily need to rush to pull that money out of. In fact, some employer plans like 401ks have really unique investments like a stable value fund. And this is something that typically does not fluctuate with the markets, but it pays a very nice rate and is very low risk. It's not risk-free. It's not an FDIC insured bank account, but it behaves similar to a savings account and pays a nice rate without going up and down. And if you're doing backdoor Roth contributions, you may want to leave assets in your employer plan. So you have to remember the pro rata rule, which means that if you have pre-tax money in IRAs, but you try to make that backdoor Roth contribution, that pre-tax balance in the IRA could interfere and cause you to have to pay some taxes and complicate things. But if the money is in your 401k instead of a pre-tax IRA, then it would not be counted in that pro rata rule. There's also the question of bias. So who is telling you to consolidate those retirement accounts and what might they get out of it? You're probably not surprised that if a large financial company says you should consolidate your accounts with us, that they stand to gain something out of it, presumably higher revenue. Or if a financial advisor suggests it, they may be able to earn more revenue by having more assets. That's not the case if somebody's charging a flat fee, for example, but it could apply with different compensation methods like commissions or assets under management. That doesn't mean that if somebody's going to earn more that they're necessarily giving you bad advice, but you want to be aware that there could be some conflicts of interest and then take everything with a grain of salt as you make your decision. I've also got custodian risk listed here, and that speaks to having all of your eggs in one basket. And this isn't something that comes up often, but it is a concern for some people. So what happens if the company you consolidate your retirement accounts with goes belly up? Or what if a hacker gets in there and drains your account? It's a really complicated area and it deserves a separate treatment from this video, but just briefly, it's nice to know that when it comes to bankruptcy of the custodian, for example, your investments are still invested in the markets or in a mutual fund that owns things that are in the markets. So if a custodian goes belly up, you don't necessarily lose your money. It's likely that another custodian would step in and buy those accounts, and the underlying investments would still have some value. Now, if custodians are going out of business, does that mean that the markets are also in turmoil? That's a good question. But if something goes belly up, it doesn't necessarily mean that you lose everything. When it comes to misappropriation of funds, again, this gets really complicated. We're not going to dive into it. But these custodians typically have some type of insurance, and they often purchase additional insurance to cover large accounts. Whether or not you'll actually be covered is way too complicated to speculate on here, but these are the types of things that you would want to research with your custodian or with your financial advisor. Then when it comes to hacking, this isn't something you hear about a lot, but anecdotally, what I've seen is that if you have kept your password secure, the custodians typically promise to make you whole. But if you have shared your password or somehow otherwise not protected it or enabled the event, then they may hold you responsible. Again, that's way too complicated to get into any level of detail here. All of that is to say that you could consider diversifying your custodians like you diversify your investments. And I don't see a lot of people do that, and I guess it has the most value if and when something goes wrong, but most people don't do that because there are some of these safeguards in place. So how do you go about consolidating your accounts? Well, you can do it yourself or you can get help from an advisor, but ultimately it's about opening a receiving account if you don't already have that receiving account opening, and then typically requesting transfers from the sending account to the receiving account. So with IRAs, you're often going to request that from the receiving IRA. But if you have a 401k, for example, you typically are going to request that with the employer. You're going to provide instructions to have them send the money over to the IRA. Anytime you're doing this with retirement accounts, it is best to do direct transfers. So this might be known as a direct rollover. That's the box you're looking for, the thing you want to click or check as you're providing instructions, or a trustee-to-trustee transfer. When you do those direct transfers, you don't take possession of the money. Nobody writes a check payable to you. Instead, the money goes from one account directly to the other account. Even if you get a check, the check is made payable to the receiving account, not you personally. And as a result, the IRS doesn't think that you took possession, and you have less risk of things getting mixed up or you having to pay taxes or tax penalties. Of course, there is that option to do a 60-day rollover, and there are limitations on that. Please research that very carefully if you think you're going to do that. I think it's just best to do everything directly. That way you reduce the risks. So let's get into some more frequently asked questions and start with the topic of Roth, because you may be confused about these 5-year rules and what happens when you combine Roth IRAs or Roth 401k to Roth IRA. What happens there? The simplest way to explain it is to say that you want to have a Roth IRA open for at least 5 years before you take distributions of your earnings out of the Roth IRA. So if you don't have one open yet and you're eligible to open one and contribute, good idea to do that, even if you only put in a couple of dollars. That way you start the clock ticking. Now, you don't necessarily have to use your oldest Roth IRA, or you don't even have to pick one that has been open for at least 5 years, as long as you've had another one that was open and funded for at least 5 years. And that can be surprising for some people. So if you have a newer Roth IRA, but you opened and funded other Roth IRAs previously for at least 5 years, you have satisfied that 5-year rule. As a result, go ahead and pick the Roth that you like best. Then when you move money out of a Roth 401k, that is typically going to take on the age of the IRA that you put it in, or they're going to look at your previous satisfying or not of the 5-year rule. So again, that's a reason to open that Roth IRA as soon as possible if you have some Roth 401k money. The Roth 401k 5-year rule is separate from the Roth IRA 5-year rule. So again, you're probably going to end up in an IRA eventually and move money out of the employer plan. That's what most people do. So get the clock ticking. Now, when it comes to conversions, that can further complicate things, and we're not going to get into that here, but just be aware that if you are converting assets from pre-tax to Roth, you want to be aware and research potential 5-year rules for each conversion that you make. Another frequently asked question here is if spouses can combine accounts, and the answer is generally no. So your IRA, 401k, 403b, TSP, Simple SEP, those are IRAs. Those are all individual accounts. They're tied to an individual taxpayer, not a joint entity, not a married couple or anything like that. They're your own accounts. You can, of course, name a spouse as a beneficiary or other people as a beneficiary, but you can't have a joint retirement account at this time. People are often unaware that they even can combine their accounts, so be aware that it is possible to consolidate your retirement accounts under IRS rules. So there's a table that you can look at, and it tells you which type of account can go into which other type of account and what potential restrictions you'd want to be aware of. So I would suggest looking that up if you are curious, or asking your tax expert for some guidance on this. But of course, you don't need to combine your accounts, and that leads to another question. People often ask, how many retirement accounts can I have? And there's really no limit to the number of accounts you can have. Obviously, it will get cumbersome as that number grows, but you can have as many as you want or need. Where the limitation comes in is typically on adding money to those accounts. So you might not be eligible to add money to a certain type of account, maybe depending on your income, or you might not be able to deduct the contributions, or if you have an old 401k, you typically can't contribute to that unless you're doing it through payroll or salary deferral, and when you no longer work there, then you can no longer do that. So the restrictions are really around adding money to these accounts. And the big question that I find people are most confused about is, will the account perform better if I combine everything into a single account? So let's say I have several different accounts, 5 different accounts. Will the assets do better if I put them all in one place and therefore I have a bigger account? And the answer is generally no. So we're looking at investment returns here. So if your account was to earn a certain percentage, whether or not it's in 5 different accounts or in one single account, and we're talking about the same amount of money, then the earnings, the amount of money you'd get in growth, is also going to be the same, whether you have it in one place or in multiple places. That said, the dollar amount may look more impressive if you have it all in one place, because if you get a small gain on a small account, it might not look like you did very much. But if you put everything together and you happen to make money that year, then you would have a nice, healthy looking growth number. But when it comes to reaching long-term goals, if you're getting the same percentage return, maybe you even have the exact same investments in all of those different accounts, it doesn't necessarily matter if you have it in one place or in multiple places. But again, by having everything in one account, it might be a little bit easier and you can potentially save some money on fees. So that could be an argument for consolidating those accounts. So I hope you found this helpful. If you did, please leave a quick thumbs up. Thank you and take care.